Hey there, awesome accounting student. Mark Franke here. This video is for Accounting 100, Chapter 13, and a follow-on where we are now going to prepare a statement of owner's equity and a balance sheet for Hog Wild. This is problem 13-2B, which is in your book on page 471 and 472. Where we left off was the income statement has been prepared. We have net income 39,880 and a gross profit percent of 61.8%. But now we're going to prepare the statement of owner's equity, which is the second statement, which will link together the balance sheet and the income statement. So we start with a heading. Again, Hog Wild. This is a retailer of motorcycles and motorcycle accessories. This is the statement of owner's equity, not retained earnings. Let's fix that. Statement of owner's equity. And of course, the owner is Nick Henry. And I'm going to take the capital balance off of the trial balance because the accounts have not been closed. So the balance on the trial balance for Nick Henry is $198,710. This comes right from the book. And let's throw a $sign on it. And maybe make it a little bit wider. Then we're going to add to that net income. Net income comes right from the income statement. It's $39,880. $39,880. And then we have the drawing account is also on the trial balance in your book. It's $56,000. You'll notice that Nick Henry took a drawing for more than his net income, so his decrease in capital is $16,120, which means his capital balance went down to $182,590. That's the ending capital, $182,590. Then we're going to prepare the balance sheet. And so I've got a skeleton set up. Again, I know this is a lot of writing, but I think it's really important. Obviously, you can just wait and you can take a picture of the screen when I'm done. But if you want to learn how to do this, you should get out a piece of paper and start writing it down. Set up the heading. Now, I have put this side by side in order for it to fit on the screen. But if I were doing this in pencil, I would just put it on a piece of paper and go straight down. And you should be able to fit this on one piece of paper. This isn't that big of a balance sheet. But if you have to use two, you have to use two. And then we'll go through the calculation of the inventory turnover down below. But for now, don't worry about that. We're just going to do a balance sheet. Now, this is a classified balance sheet. And what that means, and this is generally accepted accounting principles, says we have to separate current assets from long-term assets. Current assets are things that are going to be used up within 1 year. Current liabilities are things that are going to be paid within 1 year. If they go out for longer than a year, if it's an asset, we put them in this long-term asset category. If we're going to pay them after 1 year, then they go into a long-term liability. That way we can take a look at current assets, things that are going to be collected or converted into cash in a short period of time, and compare that to current liabilities and show financial strength. So we'll start with a heading. This is the balance sheet. It's as of a moment in time. In this case, it's December 31, 2021. And our current assets first is always going to be cash. Cash is $14,350, comes right off the trial balance. Then we have petty cash fund. The petty cash fund, or petty cash, is $200. Notes receivable, short-term notes receivable, $6,000. Accounts receivable, $54,600. We also have an allowance for doubtful accounts. And that's a negative asset or a contra asset. It's $5,000. It's a credit balance. Interest receivable, $200. Merchandise inventory, $87,915. Warehouse supplies, $3,700. Office supplies, $1,800. And prepaid insurance, $6,900. These are all current assets. Current assets are things that are going to be used up within 1 year. $170,665. Then we have our long-term assets. We've got some land, which is $20,400. We have a building. The building is $53,100, but we have some accumulated depreciation of $8,400. So our net book value of the building is $44,700. We have some warehouse equipment, $24,000, but that has accumulated depreciation of $4,000. So the net book value of the warehouse equipment is $20,000, and the office equipment is $12,800. Accumulated depreciation is $1,800. So our net book value is $11,000. So when we add total current assets with the land and the building and the warehouse equipment and the office equipment, we get a total of $765. That is our total assets. Over on the liability side, we start with notes payable. Again, these numbers are coming right off of the trial balance. It's in your book. Notes payable, $8,000 with a dollar sign. First number should always have a dollar sign. Accounts payable, $32,500. And interest payable, $1,800. So our total current liabilities is $42,300. Then we have some long-term liabilities. We have a loan payable, long term, $6,000. And we have a mortgage on the building and the land, which is a long-term liability. $35,875. So our total long-term liabilities, well, actually, yeah, total long-term liabilities $41,875. Then to complete the balance sheet, we're going to take Nick Henry, capital, and that's coming right from the statement of owner's equity that we prepared, which is $182,590. And now when we add current liabilities plus long-term liabilities plus the capital, $266,765. We balance out. Cool. Now, a couple of things that I wanted to point out that we can use for analyzing this information. The first thing, and I'm going to just put it over here, is working capital and the current ratio. So working capital is current assets minus current liabilities. Current assets is $176,665. Current liabilities, $42,300. So working capital is current assets minus current liabilities, and we have working capital of $128,365. And we'll put a thick bottom border on it. And the current ratio is current assets divided by current liabilities. So again, current assets, $176,665. And since we're going to divide, I'll put the line in the middle. Current liabilities, $42,300. When I take the current assets and divide it by current liabilities, I get a current ratio of 4. A current ratio of 4 is very, very strong. This measures financial strength. Apple Computers has a current ratio of about 1.7. McDonald's, probably a little over 1. A 4 current ratio means that for every dollar of liabilities that you can do, they have $4 of assets waiting to pay for those liabilities. Again, it measures financial strength very, very strong. And then the last thing we'll do is look at the inventory turnover. Inventory turnover is going to take cost of goods sold divided by the average inventory. And the average inventory is the beginning inventory plus the ending inventory divided by 2. So our beginning inventory is $88,980. Our ending inventory is $87,915. So if we add these together and divide by 2, we get an average inventory of 88,448. And if we divide cost of goods sold by average inventory, we get an inventory turnover of 2.58. 2.58 means that we sell out our inventory every, almost 2.5 times per year. So 2.5 times per year is probably going to be around 5 months. That's not a very good inventory turnover, right? An inventory turnover of 12 would mean once a month. And that's, pretty strong. But our motorcycles, they're not turning over very fast. And that makes some sense because they probably don't sell as fast as a bag of Doritos or something like that. So, but that's the analysis on the balance sheet, and there is our classified balance sheet, and that's it for this video. So, thanks for listening. Practice, 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 and finish strong. And I'll see you